Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, December 11th, 2023. It's 9:49 a.m. Eastern Time, and just wanted to get one out and continue to focus on the big three for now, and share, continue to share what I'm seeing and what's going on. Again, big three, I'm referring to the stock market, bonds or interest rates, particularly the treasuries, but I am watching all sector bonds. As you know, last week officially put out short trade ideas. I think you can short the whole spectrum, corporate, investment grade, low grade, treasuries, munis for that matter, if that's your thing. And then also Forex. But what I'm going to do on the Forex, again, I often cover the euro and the US dollar. We'll hit on the yen as well. Because that is, I always talk about the euro being basically an inverse of the U.S. dollar, and that's because it's by far the largest component of the dollar index. But the yen's the second largest, so we're going to look at that too. And then there was some questions I'm going to get to in a second about stop losses if you're short the Qs. But let's start out here with the market. This is that VTI I've talked about quite a bit recently, the Vanguard Total Stock Market ETF. So it tracks what was formerly known as the Wilshire 5000. I used to cover that all the time, and then this charting program truncated it, and it's still, I guess, in some form or another, because I can pull a chart, but it doesn't go back as far. Either way, this is one, and by covering this too with these levels, you can trade it. And I'm just going to read it out here. I went to the website and it's the Vanguard Total Stock Market ETF seeks to track the investment performance of the CRSP US Total Market Index, which represents approximately 100% of the investable U.S. stock market. Includes large, mid, small, and micro cap stocks regularly traded on the NYSE and NASDAQ. The fund invests by sampling the index, blah, blah, blah. So they don't hold every single one, but they sample it to get a representative, broad, diversified collection of those securities. And again, so, it's I have to say this over and over and over again because it is, this is if you're looking at this, you're looking at the stock market. If you're looking at QQQ, you're not looking at what even should be considered an index. It's a tech. It's a tech index is what it is, 50% tech. And even then, just the top 7 stocks make up almost all the returns, over half the returns, actually. So not diverse. So again, it's a trading vehicle. You can trade it all day long. They tend to move together, high correlation. But here's the stock market here. So you can see we're still very much off the highs there. Because I had, someone brought into question, it's still bear market rally. And of course, that's only time will tell. From before this bear even started, I've been predicting and forecasting a much, much longer cycle, unlike anything we've seen even for nearly a half century now. I'm looking at, the beginning of the first secular bear market. And if correct, and that, again, I've made the reasons both fundamentally and technically, but fundamentally is limited to, but not exclusively to the fact that interest rates, i.e. bonds, just completed what appears to be a nearly 50-year, 40-something year bear trend in rates, that is, secular bear market. And so that's it. We'll see if it plays out this way. And if so, the waves are going to be a lot bigger. And the good news is, even if I'm right, maybe I'm not, if you're bull, you don't like shorting stocks, you like being long only, then there'll be plenty of opportunities to trade on the long side on the counter trend bounces. But we'll see. First things first, we got to get this the near-term direction right. That's most important, especially for swing traders. On VTI, I just want to point out that nothing's changed here. We had the divergent high here, leading into the July highs, which we shorted, not via VTI, via QQQ, covered right off the lows a couple days before the lows bottom, went long, and long Treasury bonds as well. And again, admittedly, I shouldn't have been shorting. I should have waited till a clear sign to short bonds because rates continue to fall. But either way, that's where we're at now. And so, if I, hadn't seen or looked at a chart for let's say the last year, I've been sailing the world and I came into that, I'd say, wow, this is a nice setup. We have, just like we had negative divergence back then, we have even bigger divergence right now on VTI. And that's it. And so you can see pretty good resistance right here, just a little bit above. And the thing about divergence, It is not a sell signal. It is an indication. So if this goes up a little higher, we can't go too much higher. We have equal highs right now in price, and we have almost equal highs in the indicator. So it's really stretching the limits of divergence, but it is still there. Sometimes you don't have perfect divergence. Quite often, I've seen that many times where you have divergence that gets popped towards the top, especially on a very euphoric run where there's a lot of bullish sentiment and shorts have just capitulated. But that's it. I'm just going to say the facts are the facts. There it is. There's the divergence. There's VTI, and you can look at SPY. SPY, same thing. There's a lot of lines on here. You have already a marginal, ever so slightly higher high against the indicators showing negative divergence. And then in QQQ, if you recall, all the way back from here, even when we were calling this down, I had up on the board a scenario of a marginal new. It was my alternative scenario, but never eliminated because we held key support on the indexes, on all the key stocks. And so that is now in fruition. So it's not, and that's it. I was only calling for a marginal new high. Somebody asked, I think, what constitutes, bull run, or is it no longer divergent high? Well, first of all, when the divergence is taken out, then you don't have that, which is a big pillar of the bearish case right now. You have these big negative divergences across the indexes. So when that gets taken out, and those on the weekly, then it makes it a lot harder. And especially on all the indexes, again, not QQQ particularly, more so the S&P 500, VTI, small, mid caps, everything else there. So that's it. So no technical change or change in the technical posture. We've been moving sideways now for a few weeks. But let me roll into the other things I want to talk. So there's the stock market. There's the targets. Somebody asked, hey, this is, it seems like they're ready to throw in the towel. I want to know where logical stops are. And as I said, depends on what you're targeting. T1 was already hit. So if you shorted anywhere in here recently, we swung it down, gave you official targets for near term, a short-term trade, with a total of 4 targets, the first of which has been hit. And I've also maintained or mentioned, for long-term investors that are looking, that share the same mindset as me, that this is we're approaching the end of a bear market rally. We're on the very latter stages, a ninth inning, bottom, top of the ninth. Then you'd be scaling in to maybe a long-term position, which I'll get to in a second with the targets. So short-term targets, again, T1 was already hit. So if you're still in the trade, or if you recycled in after it came in the bounce off T1, then you have a maximum. This is my near-term swing targets would be a back test of the trend line. That trend lines come in and they're dynamic, different levels every day. So let's just say I'm putting the crosshairs here, and let's say we hit that. That says we would hit it where it's at now on, let's see, where's the crosshairs? Oh, December 21st, right? That would be a pretty hard down, and that's a pretty aggressive call right there. But that would be about almost an 8% drop. So, if you're in here, and again, this is where I address that. There's no one stop for anyone scaling in. If people are scaling in, or if you've shorted anywhere in here, you have different costs than the person next to you. Everyone has different cost basis. But again, let's just keep it very simple. So on that, if you're only expecting a near-term pullback and you're looking for an 8% drop followed by a new high up, or you plan to cover, then you give yourself you say, okay, a 3% stop loss gives you a better than a 3-to-1 RR on an 8% drop. So therefore you can have a 3% stop loss. Again, depending on where you shorted, it would be up here somewhere. But if you're only looking for a gap backfill, remember I said there's a gap right here, a gap that's likely to be backfilled. And that would be from where we're at right now, a drop of about 4%. So therefore, you'd want about a 1.5 or so, maybe 2% stop maximum for 2-to-1 RR, and that would be about right. Again, if you shorted right here, that's near the highs. That's about a 40, a little over 401 right there. Stop. Okay, now changing gears to the big picture. These are targets laid out before anybody even knew there was a bear market. We had 1, 2, 3, 4 targets. T4 I identified as 235-ish right there, or the blue uptrend line. The blue trend line would come in sooner, but I still think we're going to take out those lows. So now, again, this was identified back here right after the market rolled over. That's when that target was created back in January of 2022. And so now you can see the blue uptrend line comes in before the lows, would come in before the lows. And so this is what I'm open to. And so when you measure it out, you're talking a drop of, trying to get where we're at now, measure it down 40%. So you could have a 12 to 1 RR. You could even have a 13 to 1 RR. I'm sorry, a 13% stop loss, and you would still have better than a 3 to 1 RR risk reward ratio to that target. Now that's also, there's no hard buy or sell signals yet. Nothing hard, just the divergence on the 60-minute charts. As I've said recently, I don't have a very clean uptrend line or very solid support levels. I think
I have a notification
that I think this would do the trick here. You have that big island. We'll still call it an island. It's getting big now, but on the daily chart, you have a big gap right here. And so I think a break of that T1 level, former T1, which was already hit 340, we'll call it now, the level I had at 383.41, but we'll call it 383 to round down. I think that'll do the trick to really get some downside momentum going. And, let me show you one other thing, and then I'm going to get into bonds and currency. Very important that I mention what we have here this week, and the economic calendar. It's chock full of a lot of potential market movement things. I've been highlighting this every week, and they're just potential market movers. You have CPI tomorrow, obviously a big one. You have the Fed announcement. We know what the Fed's going to do and not do. They're not going to make any changes, but it's all about what Powell says. So this is really, the minutes will come out after that. That could move the market, and then we'll listen to Powell get up there and do his dog and pony show with the media at 2:30. Jobless claim. Oh, PPI, by the way. PPI right there. Jobless claims, industrial production. So a whole slew of economic indicators this week. Keep that in mind. That's where we're at on QQQ. And before I move on and get into the bonds and the currencies, I want to say this stood out to me. It's pretty stark today. Look at the right here. Oh, you don't see it. I have to move the screen thing over here. These are the components of QQQ. I always keep a watch list of anything I'm analyzing here. If I type in an ETF, it'll show me the components, and I rank them by market cap. Interesting to note. Look at that. Look at the Mag 7. Well, there's Broadcom. Oh, no, that's a Mag 7 right there, down to Tesla. Apple, Microsoft, Alphabet, Amazon, Nvidia. Look at that. They're all in the red, and by a pretty good amount, with everything else down below it green, all the way down here to one little Palo Alto Networks, almost flat. Everything's green. So we have, that's unusual. I'm just going to say it's kind of quirky to see such a stark performance. And you can see it here. So the regular NASDAQ 100 QQQ is up 0.33%. You look at it equal weighted, up 1.5. That is a big disparity. And you can spin it any way you want. You can be glass half full or glass half empty, half full, saying, oh yeah, well finally we're seeing the rest of the market participate. We know the big fangs have led the way. QQQ's already made a marginal new high, but the equal weighted hasn't, and it's looking like it. This is, to me, as a market, there's when I see what I'm seeing today, it's just it's quirky, it's unusual. It also reeks of institutions selling into a rally, because remember, every fund by nature, if they're tracking the indexes, even if it's the S&P 500, they're top heavy in the Mag 7 because of the weightings, and we know that the retail crowd, the institutional crowd, everybody's loved those stocks all year. One day doesn't make a trend. I say that often. But I did want to point that out. That's kind of unusual today. RSP equal weighted index 0.43, not nearly what we're seeing in the NASDAQ. This seems to be to the NASDAQ right here, and SPY is flat. So there's your overview on the indexes. Let me show you a couple other things. Let's before we get into, let's do treasuries. Let's do treasuries first. Okay, so last week, what was it? I think Thursday. made it official, shorting TLT, junk bonds. Again, I followed up. You can short. I like LQD as well, the investment grade corps. And so far, nothing but red sticks. Nothing huge, but you can see this is the first by far. We haven't even had anything more than a single down day since we went long. This is where we went long and strong. One of my top. It was my heaviest position, long treasuries. We milked just about every ounce out of that. T2 was that trend line, the official trade. And you can see since we went long, there wasn't anything more than a single red down. We didn't even have 2 consecutive down days. You can see the red candles there. There's not 2 next to each other. Now we have 3. So, hey, my high five in it? No, it's not. We're not there yet. The 60-minute chart where that trade was based off of, we're coming up on the first target zone. T2's down here. And we'll go from there, see if I add anything else. But, here's what I wanted to show you. Okay, this is TLT, again, the 30-year, 20 to 30-year Treasury bond ETF against, in white, compared to the NASDAQ 100. And all along, I've been, highlighting, predicting it would remain, talking about the hypersensitivity to interest rates, bonds in the stock market moving tick by tick. Because it was all about rates, and then predicting that we'd slowly see sort of a disconnect. This is a comparison. What I did, I set them to start at the same point. So again, we have QQQ in purple right here, and TLT in white. And again, don't look at the differential. I talk about that often. The differential is because they don't move in the same percentage terms day to day. Treasury bonds go up and down less than the stock market. But as I roll back here, what I'm going to do is roll my scroll wheel on the mouse, and you want to look at to the left here of the screen, and you can see how perfectly they tracked, right? Because that brings prices back into the same point. And you can see that correlation was immutable, strong. And then lately, now you can see, as I pointed out last week, I've started to notice that what I've been predicting would start to separate. And right now, it's actually really going the way opposite way I would have normally suspected. But then again, it is that separation now where the market is no longer, now it's going on for over a week, where the market is no longer as hypersensitive. In my guess here is they've already resigned themselves 100%. All market participants, I'm talking metaphorically, not literally, but the majority of market participants have resigned themselves to the fact that we no longer need to be worried about rates. Rates are only going to go down. And when you have such a one-sided mindset of the market, that leaves zero room for error. I'm not saying that rates aren't going to continue to fall. I do think we're going to get a spike in the near term, and that's why I'm short Treasury bonds. And the longer this disconnect continues, again, what I'm pointing out here, let me roll back to right here is where it started recently. QQQ, which again, remember, QQQ is not the stock market. We're seeing pressure on the small caps. Other things are going down. Treasury bonds, TLT, has been falling. That is an unmistakable. We haven't seen anything like that in a while. Unmistakable disconnect. In fact, they're moving inversely correlated now from a very tight, hypersensitive positive correlation to an inverse. So all I'm saying is there's going to be a mean reversion. Either our Treasury bond trade short isn't going to work out, and then bonds are going to rally up, and then stocks will like that, or there'll be, the market, particularly QQQ, will play a game of catch up. I mean, if we look at like SPY, let me just take a look there. You can see that has a close, oh no, that's SPY and QQQ, my bad, guys, sorry. TLT, I'd have to compare it at a chart properties and click on SPY instead of QQQ. You can see even then, it's not as much. Remember, QQQ is running up stronger. There's SPY, but there's TLT. And that's even more unusual because SPY, you have more interest rate sensitive securities. See, QQQ is tech heavy. Tech companies, they don't have, most of them, well, those that have debt only have it because it was free to take out bonds in the last few years, very cheap, I should say. But tech companies typically have a lower debt load, low dividends, so they're not sensitive like high dividend paying stocks like utilities, REITs. Those are sensitive to rates a lot like bonds because people buy them for their dividend. So that's why. And so where I'm pointing out here is you're even seeing it with the S&P, which is usually more rate sensitive than the NASDAQ 100. You're still seeing that disconnect. So take it for what it's worth. We'll continue to monitor it. I just don't think it's sustainable. So we're either going to be right on our bond trade or wrong. I like it, and I'm going to go over that now since we're on bonds. So TLT coming up on uptrend line support. You can see right here this trend line. However, you also have TYX as a yield on the 30-year bond. And as I've mentioned recently, here's my cleaner board. This is the trend line right here, where basically we overshot it by 1 day. We're right there now. If we can rally back up here, that's going to be a bearish for bonds. It's going to drive bond prices down as yields move up. But let's look at the more significant 10-year TNX. And TNX, again, this is the bond that most of the pros focus on. Even if you're going to trade TLT like I do, or the 30-year for the juice, TNX is the one watched by most market participants. And that is the 10-year yield. Very, very nice trend line. Boom, hit that, pulled back to the trend line. That's why I put the official long on. And if you look at this now, you have a nice downtrend, which if we move up much more, so we're right there right now, this is going to make or break it. And there's a lot on the economic calendar this week. And then this level, this green line too. So here it is, guys. This is, to me, big, big moment. We may not get it, but if we can pop up here above 43.58, that's about 4.36 on the 10-year. What you're going to have done then, I can all but promise you're going to have all the talking heads coming out, because this was the breakout. This was the all-time multi-year highs, I should say, in the 10-year. And this is when it started to become, this is when the first time around, remember, that was October of 2022 when the market bottomed. And this was the 100% the catalyst for the rally in the stock market, falling yields. Then they started to come up, and it didn't become a problem about right here. And that's when we had that, remember, we peaked in July. And that's when the market realized, we're in a near-term uptrend. Yields are coming back up. And then the correction really started picking up steam when we broke out to new highs right here. There was a breakout, again, above multi-year highs right there. After testing, pop, breakout. That was the final throes of the correction we just had. That's when we went long Treasury bonds. That's when we covered all index shorts back then, or at least I posted doing so and suggesting it. And now what I'm saying is we've come back down under there. And that's, to me, I think a lot of reason, a big reason why the market seems to have written off the fact that rates can go any higher. It seems to be a near lock, especially when you look at Fed fund futures. But all I'm saying, guys, I'm not saying it's going to happen. I'm saying watch out. And I'm saying I could easily see it happening based on the sentiment and the expectations being so lopsided right now. Because in the stock market, when everyone thinks one thing, usually the opposite happens. And so that's it. Just a simple level to watch. Maybe it happens, maybe it doesn't. But if it does, I'll be wrong if it does this and the stock market doesn't go down pretty hard. So watch for a breakout in the 10-year, because then that would mean this whole thing, we had a breakout. At this point right here, it officially became a failed or false breakout to new multi-year highs, right? And now if we get back above that level, you're going to hear a lot of rut rows coming from the equity bulls as to what's going on there. Did the Fed lose control of the long end of the curve? Remember, the Fed doesn't set the 10-year rate. They don't set the 30-year rate. They set the federal funds rate, which is an overnight lending rate, literally an overnight lending rate. It's not a 10-year borrowing rate or a 30-year. So watch for this, and if it happens, it just means that they've lost control, and the bond vigilantes are stepping in and saying, we don't like what's going on. Fed might cut, and they're most likely going to cut rates in 2024. Again, they're going to cut short-term overnight Fed funds rate. But if you have a lot of folks that don't want to buy into treasuries, knowing that the that the only way the Fed's going to get out of this mess is by printing more money. You may see again, they call them the bond vigilantes. They may step in and boycott buying the 10 and 30 year. And if you have more sellers than buyers in the bonds, bond prices go down and yields come up. So something to watch for. Let me not say much more on it. We're right there. So there's the levels to watch. IEF, it's the 10-year bond itself. And again, just like you had that uptrend line I just showed you that we so far bounced off of on the 10-year yield. Here's the 7 to 10-year bond ETF, and we rallied up to that. This was a breakout here, rallied up, hit it, and again, nothing but red sticks so far. Now, I'm not high-fiving because I haven't taken any profits on those shorts, but again, I think this is very important. It may be an aberration, a temporary thing where the market's just shrugging it off, again, because of their expectations. So from here, I think it'll start to be not every tick lower, but if we continue to move lower, and it's not we'll call it a range. Again, it's incremental. If yields or the 10-year bond continues to fall, meaning yields continue to go up, and I showed you the levels to watch a second ago, it could be a very sudden and swift reversal. And we're pushing the upper ends. Guys, I get excited about this stuff, but it all makes sense. So like right now, it's kind of make it or break it. So I'm either going to be wrong here, and then the yields, 10-year bonds, we don't pull back much further. They rally up, they break out this trend line. Long-term yields continue to fall. If that happens, the stock market goes higher. The stock market's going to take out those negative divergences. And yeah, we might be looking at a pretty decent rally in the first quarter of 2024. Who knows? Maybe even into year end. We've only got a couple weeks left. All right, that's it. And then currencies. Let's talk Forex. So, if you're gold or silver bug, and this is the other thing, another disconnect. It's certainly playing out in gold and silver. This is the Euro 60-minute chart. Remember, we had this bearish rising wedge I pointed out. I gave you 1, 2, 3 targets. We hit that third target. We had divergence, and we still do, and we had a bounce as expected, but we went in, made a new low. And we've been flirting with really just trading right on that T3 level I gave you before, the third target. And I said this is a possibility if we take that out. Right now, it's a stalemate. I'm not going to say, you still have the technical posture here. Bullish divergence, but remember, we're coming off an even bigger divergent high. I don't know. I don't have a high degree of confidence on which way this one goes. I can just say that if it does this, then that normally is net bearish for equities because the stock market has, as I've showed you, a very strong correlation with this as well. But this is another thing that the market has been ignoring lately is this pullback in the euro, especially QQQ, the tech-heavy stocks. There it is on the daily chart. This is where I think we might be going over time, especially if we lose this support level. See, on the daily, I have it right here. We've been trading on it. And the euro I have it somewhere here. I think it's 57.6%. Where is it? I have it written down here. Yeah, 57.6% weighting. It's been that way forever. So it's not forever, as long as I can remember. So if you're new to this, just know that the dollar, what makes the dollar, it's relative to other currencies. That's what makes it in a vacuum. The dollar is worth pretty much nothing, if you will. What makes the U.S. dollar go up and down, and it has a tremendous impact on financial assets, gold, silver, the stock market, is what the other currencies do. So some folks get all tied up in, well, the U.S. is going to be printing a lot of dollars, is going to make it go down. No, typically, generally, it's one country's interest rates versus another. So if the Fed starts to get dovish first, lowering rates, that should make the dollar go down against the other currencies. However, that's in a vacuum. But Europe, Japan, and the rest don't even matter, guys. That's why you're not going to have me cover the Swiss franc or anything else, because the euro is 57.6% weighting of the U.S. dollar index, and then the yen, JPY USD, is 13.6. So right there, you have over 70% these two currencies make up over 70% of the dollar index. So again, you take every other currency that's in the dollar index, add it up, and it's less than 30%. So that's why I focus on these. So I just wanted to cover this one. So the yen put in this divergent high right here recently. That was just like this was a divergent high. And then the yen broke down from this uptrend line right here. I'm sorry, the U.S. Oh, God, guys, this is backwards now. I'm gonna freak you out here. This is the USD versus JPY. So that means when this chart is going up, the dollar is rising against the yen and vice versa. So when this is falling, the dollar is falling against the yen, and the yen is stronger. So watch this. You have a trend line here. You also have a pretty significant level right there. You did put in a pretty big divergent high. So this is something I'm watching as well. The euro, again, is the big one. I just wanted to mention that. And again, you can see here, we can look at it here. I had it on the daily chart. See that pullback in the euro US dollar pair? And you look at gold and silver. And if you're wondering what happened, I mean, that's what happens. Gold and silver, gold. Long term, I still like it, but near term, if you have a big position and you're not keeping an eye on the euro US dollar pair, you're doing yourself a disservice. I always cover the euro US dollar in my analysis. And if it looks like your euro US dollar pair is going to pull back and have a pretty good correction, then you want to be out or short gold and silver and GDX. And silver took it even worse. Silver's just got pummeled with that drop in the euro. Look at that. It's been down. It's up almost 11% now. Nothing but red sticks. And again, that's not mere coincidence. That was that right there. They both peaked. And then you can also look at, if you don't have that pair, you can look at FXE. It's the euro right there. You can see the peak right there. And you can overlay them as well. Edit chart properties. You want to put up gold. Let's just make this gold. GLD. And add it to that. And you can see the unmistakable correlation. You can see the lines. You can't miss that. And there it is. Now, you want to see, go here, edit chart properties, and instead of gold, let's put up QQQ, and you can see also that very, very strong correlation, both moving up and down. And then this is unusual. It's very stark. There is going to be a mean reversion. Which way I think it's going to go, whether this comes up. A mean reversion can be that this can continue to go down, and then QQQ plays a game of catch up to the downside, falls even more. You could level out. You could even come up a little, but this is not sustainable. And so that's it, guys. Those are the things. And again, I call them the big three. It's not that complicated. Follow each. And then, try to make, what I try to do is as accurately as I can, and on a daily basis, go back in, reset my mental cache, look at the charts again. If I can make a strong case for the euro to bounce, let me turn that off. When I look at the 60-minute chart, I can't make a strong case. This is a 60-minute chart. Back here, I could, and I'm just drawing it up in real time. I had nice big divergence right there, positive divergence at the low, got even steeper right there. And so I could make a case for a rally. That's when we went long bonds. That's when we covered shorts. That's when the stock market started to rally. But right now, you can see recently, as I did with the EUR USD, I made a case for a pullback with the divergent high. And now the $1 million question, is that it? I have to say, this is pretty good support. And this is where the euro, quote unquote, should bounce. But if it doesn't, that's what I'm trying to say. If it doesn't, and you continue to see this fall, I would feel pretty confident that the stock market's going to get the memo that, hey, there's something else going on here. And you could see rapid positioning, shuffling going on, where institutions especially start to reassess the direction everything's at. I'm just showing you. I'm just drawing out here. It's bothering me to see the divergent lows and the divergent highs. There was a peak right there. You had a little divergence right there. Small divergence coming down there, right into the highs. All right, let me wrap it up here so I can get the video out to you guys. And again, the takeaway. Again, one day doesn't make a trend, but here's I'm just slid over this. Something's fishy right now. Something's fishy. I know there's a lot on the economic counter, but look at them, just the Mag 7. Everything else green. That's unusual. So that's it, guys. I'm still, maintaining, we got this divergence. There's kind of divergence, but, there's no change. I don't know how I would change my outlook if we're trading today where we were a few weeks ago, and more importantly, a few months ago. If the scenario I was calling for is an alternative scenario and a very likely and one of a marginal new high, and that means marginal over that July high, and that's exactly what happened. And we're trading right now within spitting distance of that high. So that's it. And this week is either going to make or break that. I think has the potential to, at least. I'm going to wrap it up here. The levels to watch. I will, be glad to answer any other questions, any other updates, any other trade ideas. If I'm missing something, let me know, and I'll take a look at another security. But right now, just to get through the end of the year, this is when I kind of step back, don't trade as actively. I'm just going to focus on the equity markets. If I see any individual stocks or commodities that stand out, I'll certainly highlight those. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.